four words, right? There is profit, there is gain, there is business, there is profession. So this chapter is what we are going to understand today. So we'll start with this understanding these four words. That is, one is profit, one is gains, one is business, and one is profession. So all these four words is what we are going to understand to start with. So we'll first understand the concept of business and profession. Business and profession. So how do we understand? We understand by understanding the meaning. So we'll go with what is business? What is business in general terms? What is business as per Income Tax Act? Similarly, what is profession? What is profession as per Income Tax Act? So we are going to understand these two words. The first word is what? Business, right? So when you say business, it has already been defined under Section 2, Clause 13. When we say Section 2, if you actually remember, any act, for example, starting with your Contracts Act or any act for that matter, Section 2 is called as a definition section. Section 2 is called as a definition section. Most of the act, Section 2 will have these definitions which are relevant for the entire act. So for Income Tax Act, there are various definitions provided in Section 2. In that, Clause 13 provides definition for business. So what does it say? It says it includes any trade. So it includes any trade. So which means any transactions between two persons for the purpose of trade, and it could include commerce. So any business transactions, it need not be necessarily trade. Any commerce activity, or it could also be manufacture activity. Okay, so it could be a trade or any business or specifically manufacturing. So all these three are called as business. Apart from this, if it is any activity that includes adventure concerned in the nature of trade, commerce, or manufacture. So being a definition, it has put out in a detailed manner. What do we understand? We understand it in a manner that any business, that is any transaction which results in profitable transaction, that is the intention of the transaction is to do a business transaction, to do a trade, to do a commerce, or to manufacture and sell. So these transactions is what is called as business. So that income, any income from these transactions of trade, commerce, and manufacture will get covered in this particular chapter, PGBP. Similarly, the other word, what we are going to understand is profession. When we say profession, there is a very beautiful definition given in Section 2, Clause 36. Okay, Section 2, Clause 36. What does it say? It says profession includes occasion. That's the only definition. So Income Tax Act has not gone beyond it. So we rephrase it in this manner, saying that profession has not been defined. Profession has not been defined in Income Tax Act. It only says profession includes occasion. So it doesn't define profession. It only says profession includes occasion. So that's why we are saying it is not defined in the Act. It is not defined that, because what is the meaning of profession? When we say business, we say trade, commerce, manufacture. But when we say profession, there is no definition. It only says profession includes occasion. Now, before getting to understand this term profession, what is occasion? What is occasion? Occasion is basically a particular form of activity which probably does not require any learned skill, which means you need not go and study that course somewhere. Example, painter. You need not go and study a course. There might be a course on painting, but it's not required. Most of the painters would not have done any course on painting. Same way, a sculptor, an author, astrologer, to write a book, to study about astrology, you actually need not go through any education stream. Like as you have this chartered accountant, company secretary, cost and work accountant, BCom. So you need not do any specific course to understand this. I might be a chartered accountant and also an author, right? So being an author is an additional thing which need not require a separate education stream. That's why we say profession includes occasion. And what is occasion? occasion is a form of activity which need not have a proper educational stream. So that's what profession and occasion is about. Now, we said profession is not defined in Income Tax Act, right? We did say that. Now, just to understand it, there is a section called 44AA. We'll, of course, understand this a little later in our classes. As of now, to know what is section 44AA, 44AA tells you who are all the taxpayer, who are all the assessee, who are all the person who should maintain books of account. So in that, the word profession has been listed out. They have listed out various category of activities which will be called as profession. So typically, the first one is legal, then you have medical, you have engineering, you have architectural profession, and profession of accountancy, technical consultancy, and interior decorator. So all these things are listed as profession, which means profession is not defined, but there is a list of activities which are mentioned as profession. So what are they? As we said, legal, of course, a lawyer, a doctor, that's what we call as medical, and engineering, an engineer, architectural profession, and interior decorator, who are involved in construction of building and other things. Profession of accountancy, that's what we are, right? So we are all what called as profession of accountancy, and any technical consultancy. So for any consultancy which requests technical knowledge. So this is what you mean by profession. So now when we say business and profession, we must understand we should also include occasion. So we are now saying business, profession, occasion. Everything will be treated alike in income tax. So there is no differentiation between how you treat a business, how you treat a business. All these income from business, profession, occasion must be categorized under the PGBP, that is profit and gains of business and profession. So that's what it is about. Now, when we say there is a trade activity or there is a commerce activity, some business activity. Now, the general understanding, each one of you here, if you think what is a business, you generally think it is a continuous activity. That is, it happens during the year, right? So, for example, if you take any company for that example, take Zomato. What do Zomato do across the years? Next year, the year after that. So it's like a going concern, right? So that's what you think. So typically, a business is supposed to be a continuous activity, but it is only, it is not a mandatory requirement, which means even one single transaction could still be called business if you categorize as a trade, commerce, or a manufacturing activity. So if you could categorize into these definitions of business and profession, even if it is one single transaction, let's say I am a chartered accountant. Okay. Now, as a chartered accountant, across the year, I'm only working for 4 days in the year. Rest of the year, I'm taking break. How great it will be, right? You only work for 4 days. You don't work for the rest of the days. You earn in those 4 days. You spend for the rest of your year. So what do? I do business for 4 days in a year. The rest of the days, I don't do any business. I just relax myself. I go on a tour. I travel across whatever it is. So is this 4 days a continuous activity? No, I've just done an activity for this 4 days. Is this a business? Is this a profession? Yes, because though it is not continuous, the intention is to earn as much as possible in the 4 days to make sure I am able to spend for the rest of the year. So typically, even if it is not continuous, it could still be categorized as business or profession if it falls under one of these definitions. So if it could be categorized under these categories, then it could still be called business, even though it is not continuous activity. And what happens is, another example could be something like a joint venture. So what do joint venture do? They combine, okay? They become an organization, they become an entity for a short time. Let's say 3 months. They have formed together to build something. So after 3 months, the entity is not at all in existence. The business is not at all in existence. It is only for the 3 months they do that activity. So which means even a single venture could be called as PGBP depending upon the scenario. So if the intention is doing a business or profession, it doesn't matter that it has to be a continuous activity. It could still be even a not a continuous activity. So that's what we have. So what have we understood from this slide? We have understood the term business. We have understood the term profession. We said profession includes occasion, that all three, business, profession, occasion, are treated alike in income tax. We also said these activity, these business, profession, occasion need not be a continuous activity. It can also be, and one single transaction also, it is generally continuous. It is generally continuous, but need not be necessarily a continuous activity. So that's what this particular concept of business and profession is about. Now, what did we say? We said when we said business and profession, we will also try to understand the other two words. What are the other two words? Profit and gains. So we'll try to understand what are all the other things that we need to know. So when we say profit and gains, we are going to understand, we are going to know what are all the key principles to refer something as profit and gains. Because generally we know what is profit, right? For example, I buy something for 80, I sell it for 100. So the 20 rupees is my profit. What is gain? Something like your capital gain. What do? You buy and sell shares or something, or suddenly you have earned some income. You have bought a lottery ticket. You have got some money. So these are all called as gain. So it could be a profit or a gain, something that has come to you. So this out of business or profession will be categorized in this third head of income called PGBP. Now, if you actually look at it, one thing that we need to understand that there are principles to know when should you call something as profit and gains. The first thing that we need to understand is cash or kind, which means the business transaction that you all do can also be barter system. We all remember 11th standard commerce, right? 11th standard commerce. If I'm right, I think we studied barter system in 11th standard commerce. What does it say? It says goods for goods. So you give a good, rather instead of getting money, you again get a goods back. So you exchange. So this exchange could also be in kind, which means it need not be cash. It could also be in kind. For example, I am doing an audit service. Instead of giving me, let's say the fees is 3 lakhs. Instead of giving me 3 lakhs, the client is giving me something worth of 3 lakhs, something worth of 3 lakhs. It is still my profit. It is still my gain. It is still my receipt. Why? Because it is in kind, which is equivalent of cash, So when you say kind, the cash equivalent on the date of receipt, will be considered as your cash. So that will be considered as your receipt. So that's the first thing. The second thing, capital receipts. There are two types of receipts, right? You would have studied in the basic concept. There is revenue receipt, there is capital receipt. Now, what do you mean by capital receipt? It is basically not revenue, right? So when you say capital receipt, it's not revenue in nature, which means it's not during your regular day-to-day operations. It is not an event that happens during regular day-to-day operations. You don't buy an asset as a day-to-day operations, right? Let's take, for example, let's take a builder, okay? Let's take a builder, a particular builder. Let's take DLF, for example. So DLF is into real estate. Now DLF is selling a property. According to DLF, whatever they are receiving for selling a property, is a business receipt, is a revenue receipt, right? So it is a revenue receipt. So when DLF sells, okay, sells a property, it is what? It is revenue. Whereas as a common man sells a property. What is this called? This is called capital gain, right? So it is a, why is it called capital gain? Because it is a capital receipt. So now, so typically a same transaction could be revenue receipt in one person's view, capital receipt in another person's view. Generally, as far as your business or profession is concerned, capital receipts are not taxable. Capital receipts are not taxable. Just that it to be taxed, it must be specifically provided in the act. Only then it is taxable. We'll see some instances in the subsequent slide. So typically, please remember, as of now, please remember, capital receipt is generally not taxable unless specifically provided in the act. So the word is, it must specifically be provided in the act. So that's when you call it as a capital receipts. The third concept is called as voluntary receipt. Voluntary receipt. So what is voluntary receipts? Basically, voluntary receipt is, I am not doing any service. I am not doing any service, but as a contribution, as a gratitude or something, my client is giving me money. Let's say I did audit, okay, audit for financial year 21-22 to some company, ABC Limited. Now the fees is rupees 3 lakhs. Okay, this 3 lakhs I bill. Okay, so I bill this 3 lakhs plus GST will be billed to ABC. Okay, so ABC will give me that money. So let's say this is happening in October 22. In November 22, ABC gives me 2 lakhs to me. So they give 2 lakhs to me. And for what reason? No one knows. ABC says, see, I'm very happy with whatever you have done. So you need not bill and all. I'll give you 2 lakhs. I'll give you 2 lakhs. You need not bill me and all. I am very happy with your work. I'll give you 2 lakhs. Of course, this can never happen in real life situation. It's a very unimaginable situation, right? Someone giving you extra for the work you have done earlier. So this is practically very rare, but generally what happens now, I have received this 2 lakhs. After I receive this 2 lakh, is this my business income or not? The question is this a business income or not? Yes, it is a business income. So what the law says is it could also be voluntary receipts, which means there is no requirement, but you're still receiving something. You're still receiving the course of business or profession. So in the course of business or profession, I'm getting some extra money for some work I've done earlier or for no work. It could be any reason. But I have received extra money. This money is what you're actually calling it as voluntary receipt. This is also a profit and gains of business or profession. And the fourth one, application of the gain is immaterial. So typically, there is no requirement that I should spend that money. For example, let's say I received this 2 lakhs, okay, this 2 lakhs. I don't spend anything in this 2 lakhs. I've just kept it inside my safety locker. I'm not doing anything. So it is just lying wherever I have just kept it. Now this 2 lakh, I'm not spending anything. Can I say you're not spending, you're not applying the money, so it is not an income. So application of gain is immaterial. So that's the next thing. So basically, it need not be spent. So that's the first thing. And it need not be spent throughout the year. So it is not required that every year I have to spend. It could be like, what an example I could take is, let's take a broadband connection, an internet connection. Like, let's say some act broadband. So typically for this broadband, I'm not paying monthly. I am paying 1 month in a year. The rest of the month I'm not paying. So which means I'm only spending it once in a year. For the rest of the month, I'm not spending. It is completely okay. So first of all, there is no requirement to spend. Even if you are spending, there is no requirement that you need not spend it throughout the year. So that is also not there. Gains made by public bodies is one of the example. So any public bodies like an institution or an association where they receive money from members, there is no requirement that it actually needs to be spent or something. So whatever the gains made by these bodies will be called as application of gain is immaterial. So this is the fourth principle. The fifth is legality of income. Legality of income. So when you say legality, income tax is not bothered about whether the income is legal or illegal. Income is legal or illegal because it doesn't matter whether it is illegal also. So even a smuggler should still pay income tax, because it is, though it is illegal, it is liable to income tax. Of course, the smuggler is not going to report his income, so it's like a black money. So when identified, he is supposed to pay taxes. So that's the fifth concept. The sixth concept is each business. For example, as an individual, I am a partner in 3 firms. I am doing proprietor also. Now, all these 4 businesses should be independently calculated. So all the business that I'm involved in should be independently calculated. So let's say there are 4 business, A, B, C, D. So I'm running 4 businesses. Now all these 4 must be independently calculated. How much I get from each of the business? Let's say I get 60 from this, 80 from this, 45 from this, 15 from this. So it is 120, 200. So now this entire 200, whatever you are calling it as 200, this entire amount of 200 will be categorized. So the entire amount of 200, so this entire 200 will be taxable. So you compute independently, but then tax collectively. So when you pay tax, you pay for 200. When you compute income, you compute for each businesses. So that's what this concept of 6 and 7 is about. So for each of the business, you calculate how much deduction, how much expense, whatever it is. Finally, you calculate the thing. And when you calculate your income, what is calculated as your income is not the gross receipt, which means if I receive 100, what is taxable is not 100. 100 minus my expenses. So the net, the profit alone is taxed, not the receipt as such. So whatever you received is not taxable. Whatever is your profit alone is taxable. So that's what you're calling as the principle. So there are 7 principles. As we said, cash or kind, it could still be treated as PGBP. Capital receipts are not taxable unless specifically provided in the Act. Voluntary receipts, it is still taxable. And when you application of the gain is immaterial, so it doesn't matter whether you're spending it or not. Legality doesn't matter. So even illegal income is taxable. And then each business, when you have multiple business, each business should be distinctly, independently calculated. But when it comes to tax, you combine it. So that's what it is about. And finally, when it comes to computing the income, each business is eligible for their own share of deduction, own share of expenses. So what is taxed is the gross, is not the gross receipts, only the profits of each business. So that's what the 7 principles of profit is about. So any doubts, you can keep sharing now and then. I'll probably clarify it one and then. So instead of cash, payment is made in for gold. Yes, Priyanka, you're right. So instead of cash, when you're giving it as gold, it is something called as a kind. So that cash equivalent, whatever is the rate of gold on that particular day, will be treated as your cash receipt. Dhyane Shingle, yeah, capital receipts are taxed only in capital gain, but we will see some scenarios which is also taxable in PGBP. We'll see in the subsequent line. Jyoti, I'm really sorry. I'm not good in conversing Hindi, so I'll probably explain it again in English itself. Application of gain is immaterial, which means it doesn't matter whether I'm using my income to spend something. I'm using my income to spend something. So, which means whatever I receive is taxable irrespective of whether I'm making any expenses or not. So I need not use that money to make any expenses. So whatever I receive is taxable irrespective of whether I'm applying it or not. So it doesn't matter whether I'm using my money or not. Moment it's a receipt, it is taxable under PGBP. Please explain point number 4. I think Manoj, yeah. So basically this application of gain is once I receive an income, even if I don't have any expenditure, the money is still taxable. So which means whatever I receive is taxable irrespective of whether I am having any expenditure or not. So that's what it is about. Petladwala, I think I'm pronouncing your name correctly. Yeah, I'll upload this PPT after the session. Kavita, what is distinct business? So typically, let's say I am a proprietor, okay? I am running a beauty parlor. I am running let's say, a mobile trading company. I am also running a service, repair and service for all home appliances. So I have three business. Okay. So distinct businesses. When I have two business, my business A is beauty parlor. Business B is mobile trading. C is repair of home appliance. Okay, let's say I have these three business. All these three business is distinct business. It's distinct, which means independent, a different business. Distinct is basically what? Different business. So A is a different business, B is a different business, C is a different business. So I have to compute income of these three business independently. How much did I get in A? How much did I get in B? How much did I get in C? And then total it. So that is what is finally taxed. So that's what you mean by distinct business. Pranav, Vashishta, yeah, if it's a service for service, for example, I am giving some audit services to a particular company. They have created a particular software for me. It is service for service. Whatever is the value of service on that particular day should be kind. So kind, when you say kind, it also includes service. Anish, if voluntary receipt is capital in nature, does it taxable? We'll see when is a capital receipt taxable. So voluntary or not voluntary is not matter, but we'll see scenarios where capital receipts are taxable. Yeah, Sachit, illegal income is taxable. Anish, can we conclude if someone falls outside the business, then will they be treated as profession? No. So business is a separate category, profession is a separate category. So they must fall in one of these categories. So just because they are not falling under the definition of business doesn't mean they are doing profession. But the reverse might be true. For example, when someone thinks they are doing a profession, income tax says it's not a profession, it is still a business. So the reverse might be true. But just because it is not a business, it will not be treated as a profession. Arshid, we have to understand meaning of adventure in business. You actually need not understand. Maybe we'll put it in one single word. Any activity which involves risk for which you are rewarded. Please understand, any activity which involves some kind of risk for which you will be rewarded. So this risk and reward is basically called as adventure. Yeah, Abdul, I'll correct your name. Thank you. Tanisha, occasion. What does occasion means? As I told you, occasion does not require a separate stream of education. For example, as a chartered accountant, you must pursue and complete CA to become a chartered accountant. To be a company secretary, you must complete CS and only then you become a company. Same with BCom, MBA, BBA, any course, right? So these are all education streams. But when you say occasion, a painter, an astrologer, an author, they need not do a separate course. They need not do a BA English to become an author. They need not do a separate language course to become an author, right? So any course, any activity which is an art form, So that's what you actually call it as. An art form is what you call it as occasion. So typically, occasion could be something like an art form which need not require a separate stream of education. So that's what it is about. Ekrar, yeah. Any amount received for religious purposes is a voluntary receipt. It is predominantly like trust, right? You come and donate, and donations are used for the purpose of trust. So that's one of the example. Good. Pranav, no. See, both business and profession needs to be continuous. Generally needs to be continuous, but it can be one-time activity also. So it's not like profession alone can be one time. No. both business and profession can be one time. It is completely okay. As I told you, a joint venture. Two companies come together, form a joint venture. They do that business only for 3 months or 6 months, then wind up the business. So that business activity was only for 6 months. For example, I'm sure most of you will know Formula One race. Formula One is a car race, right? So to happen a car race, there was an organization set up in India for only 1 week time. That 1 week that race happened, they earned money and then the entity was shut down. So even if it is for that 1 week, it is still a business income. So which means even business can be not continuous. So it's not something like profession alone is not continuous. Even business could be not continuous. Such is the daily wage earner like home constructor. Yeah, one who's in this any labor work in form of construction, if they are receiving money as part of the hours of work they do, they'll be, if it is wages, it will be categorized as salaries and wages. If it is not wages, they're doing for multiple people, then it will come under business. Only the interior decorator and architect are called as profession. Arshit, how do we tax the kind? As I told you, we need to take the cash equivalent. As one of the earlier questions spoke about gold. So what about the gold? The date on which you receive the gold, that value of gold on that date will be the equivalent of cash. So that's what it is. Harini, if you do a course, will it not be called as a occasion? No. The point here is occasion does not require a specific course, but doesn't mean that when you do a course, it is not an occasion. Occasion is a form which can be learned independently and also through an education stream. So it is like you only have to see, can that be learned even without that education stream? That only have to be understood. Dormant company, dormant company, yeah. In that year, let's say there were activity for 3 months, rest of the 9 months there was no activity, it will still be called as an business, even if it is not continuing anymore. Abhishek, see, profession is basically, I don't think you can do a profession without a proper education stream. It's a very rare case. For example, to be a chartered accountant, you must be a CA. At least you must have completed to do some form of audit services. You'd have at least completed BCom or some course or something. So it requires a separate form of education. But of course, we leave that aside because it is not much relevant for your examination. See, what we must understand is profession are specifically listed like doctor, lawyer, an accountant, an interior decorator, an architect. So all these are listed as profession. It also includes vocation. So vocation is a specific art form related activity such as sculptor, painter, author, astrologer. All these are called vocation. So that's what it is all about. So profession is basically where you require a specific skill. Business is something general term. So profession is a specific skill. Business is a general term. That's what probably if you ask me to summarize, business is a general term. Profession is a specific skill. Only when you know that skill, you can do that activity. So that's what you mean by business and profession. Okay. So that's what it is about. So we'll move on to the next category of activity. Next slide, basically. Some issue with the sharing. Please give me a second. Yeah, I hope you are able to see the slide right now. So let me continue. So with that business and profession, next thing we are going to understand is how do you maintain your accounts? How do you maintain your books of account when it comes to business and profession? So section 145 says For both PGBP and IOS, that is income from other sources, IFOs, right? So it is IFOs. So for both PGBP and IFOs, you can maintain the books of accounts either in cash accounting or mercantile system of accounting. What exactly is mercantile system of accounting? It is a form of accrual system, right? Irrespective of whether you have made that expenditure or not, if it is for that year, you account it. So you either follow cash system of accounting or mercantile system of accounting. So that is about method of accounting. But there are some exception. There are some exception to it given in section 145B. What does it say is these two transactions, that is interest in the form of compensation. So interest in the form of enhanced compensation is taxable in the year of receipt. This is categorized under IFOs. We'll see that in that when we discuss about IFOs. So typically, generally an accounting system should be followed in cash or mercantile system of accounting. There are some exceptions, couple of exceptions, irrespective of the method you follow, it will be taxable in the year of receipt. So even if you follow mercantile system of accounting, these two transactions will only be taxable in the year of receipt. One such example for business or profession is subsidy grant. So when there is any subsidy from government or any organization, it is taxable only in the year of receipt. Otherwise, it is not taxable. So basically, generally an income is accounted in the form of cash or mercantile system of accounting. It is taxed in that manner only. But there are a couple of exceptions. One is interest on enhanced compensation. Another is subsidy grant or any refund received is only taxable in the year of receipt. So that these are the exceptions. Apart from this, one more thing that we need to understand when it comes to income taxes, there are some standards. I think as a chartered accountant, we already know there are several standards, right? You have accounting standards, then you have what? Auditing standards. So we already have standards in each of the chapters. So you have accounting, you have audit standards. Apart from these two, there is also one more standard that you're going to learn during this course, but not during inter, right? Not you are going to learn ICDS during the course, but not in inter, which means it is a chapter which will be covered in final. So it is called as income computation and disclosure standard. So it stands for income computation and disclosure standard. So this is a separate standard. There are 10 standards listed by the government to tell you how do you treat a particular income or expenditure for the purpose of Income Tax Act, So this tells you that you must follow mercantile system of accounting. So they say that you generally have to follow mercantile system of accounting. But what are the 10 ICDS? What does each of the 10 ICDS tell you will be studied in final, not in inter. So we are going to skip this just here. We are just going to know that there is 10 ICDS, which is called as income computation and disclosure standard, which suggests mercantile system of accounting, recommends mercantile system of accounting for various business associates. So that is about method of accounting. So with this, probably now we have understood the very basics of what you call business and profession. Now we'll move on to the sections, which actually tells you what are all taxable, when it is taxable, how much is taxable. So what are we going to understand? We are going to understand what is taxable. Okay, what is taxable? When is it taxable? How much? When you say how, it is how much. Okay, so you are going to understand what is taxable, when is that taxable, how much is taxable. So we are going to understand these three questions across business and profession. Okay, so we are going to understand. Now, first thing, for all this, you have what? Income. That is your what you call. We'll call it as sales. Okay, so we'll call it as sales or receipts. then you have expenses, right? So what are all the income that will be taxable under PGBP? What are all the expenditure that will be allowed under PGBP? So we are going to understand when is it taxable, how much of that is taxable. So this is what we are going to understand in this PGBP chapter. When we talk about this, we'll start with this concept of receipt, okay? That is sales or receipt. So we'll start with this. So basically, when you call an income, to tax an income, income tax has something called charging section. Correct? You'd have studied in your basic concepts what is meant by charging section. For example, in salary, section 15 is a charging section. So similarly, in business or profession, section 28 is a charging section. So section 28 tells you what are all the income that is subject to tax. So this is what you're basically calling it as an income tax. So basically, when you say income tax, a particular income will be taxed only when you say it is taxable. So Income Tax Act should tell this is chargeable to tax. So that section is called charging section. For business or profession, it is section 28. For business or profession, it is section 28. So we are going to understand about this section 28. So 28 has listed various items which says these are all transactions which will be taxable under business or profession. So if particular receipt or income is listed here in this particular section, only then it will be categorized as your income chargeable to PGBP. So we'll see one by one. The first thing that we are calling is profits. Okay, so what do you mean by profit? Any profit and gains that is arising during a business. So you're running a business, you're receiving some profit or you're receiving some receipts, that is taxable. So it's a very basic thing. So when you do a business, you will earn profit out of it. You will have gains out of it. That profit and gain is generally taxable. So that's a very basic definition. It be a business or a profession, you will earn profit out of it. That is taxable. Next thing is when it comes to association. So any income derived by an association, that is, let's say, Institute of Chartered Accountants of India, Chamber, Commerce Chamber. So there is various business bodies or trade bodies or any professional organizations. So that organization, whatever they are collecting from the membership fee, the subscription fee, all that becomes an income. So now that is for association. The next is incentive on export business. So government, like now currently what do you have? You have something called Atmanirbhar Bharat, right? So which means you have to make in India. So whatever you have made in India should be used in India, should also be given outside India. So this is what you call it by Atmanirbhar Bharat. Now, what happens in this government says, we are very happy you manufacturing or you producing something in India. We want you to export. So government gives you various incentives for engaging in export business. So this is what you call it as an incentive on export business. So typically, any income, any receipts that you're receiving in form of cash assistance. So cash assistance for any exports that you're doing, that is also is a taxable income. Similarly, any duty, that is customs or excise duty, which is given to you, when you say drawback, is given back to you. Whatever duty you paid, some part of it or the whole part of it is given back to you. So that is what you call it as duty drawback. So any duty paid by you is given back to you, refunded to you. That is also an income. Similarly, another is also relating to your duty drawback only. So that is also relevant, treated as an income. So typically, in short, if you want to remember, any amount given by the government for purpose of export. So you're doing an export business, government is encouraging you to do more export business. So they're giving you some cash support or they're refunding you the duty that you have paid, this is an income under Section 28. Please understand, any cash assistance for export or any duty drawback for export is an income. So that's what you mean by export business, incentive on export business. The next is, it could be any benefit. Any benefit. We said voluntary receipt. So we said cash or kind. So we said voluntary receipt. We said cash or kind. So these two, so irrespective of whether you are providing any service or not, if you have received any money, so it need not be money. It could also be like a perquisite. What is perquisite in salary? What is perquisite in salary? Try to recollect your salary portion. What is perquisite? So basically, a perquisite is an additional benefit provided to an employee. What are some of the examples? You can keep telling. Of course, I can't hear you, but you can keep telling what are all called as perquisites. Some examples of perquisites. I'll try to remember salary chapter, and I'll try to come out with some of the perquisites. Motor car. And then you have what? Accommodation. It could be a rent-free accommodation or something. So you give accommodation or any, anything, something like any support. You have given a fixed asset for use. You have transferred a fixed asset. So all these are perquisites, right? So some extra benefit given to an employee is called perquisite. Similarly, in business, apart from the fee that you are raising, apart from the invoices you are raising, if you are getting any additional benefit or perquisites, that will also be called as a business income. So please remember the concept, benefit. We spoke about a couple of principles, cash or kind, voluntary receipts. So benefit could be categorized under those two principles. So it could be a form of voluntary receipt, or it could be form of a kind. So that's what it's about. And partner's income. Any income earned by the partner from the firm. Let's say I am a partner in Vinod and Muthu Chartered Accountants. Now, whatever income I'm receiving from my firm, it could be my interest on capital, it could be my remuneration. Whatever I receive from my firm VMCA will be taxable as business income to me. So that's what it is. So any interest, salary, bonus, commission, or whatever you call it, if it's being paid to a partner by a firm, it is taxable under PGBP, not under salaries or income from other sources. So whatever income received by the firm is taxable under your PGBP and not under any other chapter. So that's what it is about. Whatever extent allowed under Section 40B, I am not going to explain this. I will explain it in the subsequent slide. For this slide, please remember only to the extent allowed under Income Tax Act. So whatever interest you receive is not taxable. To the extent it is allowable, is what is taxable. I am not going to explain it further. We'll see when we are understanding the Section 40 Clause B. So for time being, what should you know? Any income received by the partner in the form of interest, bonus, salary, remuneration, whatever you call it, is taxable under PGBP, not under salaries or IFOs. Clear? And apart from that, abstain. This is a very beautiful concept. It is basically an amount received or something received for not doing anything. Not doing anything. So imagine someone paying you for not doing anything. They're coming and telling you, please wake up in the morning, take bath, eat, sleep again, then again eat, then again sleep. So repeat this for throughout the day. You don't do any activity, but I'll still pay you money. If someone tells you how great it will be, I'm not sure whether it is actually great or not. Definitely not good. But just imagine a situation where someone is paying you for sitting idle, for not doing anything. This will be covered under PGBP. We'll take some examples. So first is basically for not carrying out any activity in relation to any business or profession. Now let's take an example. ARC and Co. It's a chartered accountant firm. Okay, it's a chartered accountant firm. There are three partners. ARC. Okay, there are three partners in this firm. Now this C is retiring. Not retiring, is resigning. This ARC says, I will pay you 15 lakhs for what? C must not carry CA business, CA profession. C must not carry CA profession for next 10 years. Or let's keep it as 5 years. So for next 5 years, you are not supposed to do any CA activity. For that, I'll give you 15 lakhs, which means C is coming out of ARC and Co. ARC and Co says, I'll give you 15 lakhs for what? For not doing any further business activity, for not carrying out any activity. When can this happen? When ARC thinks if C comes out and starts a new business, existing clients of ARC might become the client of C's independent practice. So which might be a loss to ARC and Co. So to compensate that loss, to make sure that C is not pulling out the clients, ARC and Co says you are free to resign from ARC and Co on one condition. You are not supposed to do anything for next 5 years. I'll give you 15 lakhs for that. This is what called as abstaining. Not doing anything. And similarly, not sharing any no patent. Okay. Now let's take the same example of ARC and Co. 3 partners, ARC. Now, C has invented a CA software. There are various tax softwares, like there are Winman, Computex. There are several softwares. Of course, you will know when you join articles or when you start working in a CA firm, you will know about the CA software. Now, in our example, this C has designed a new CA software, which is much useful than many other existing products in the market. Now, ARC and Co feels, what if C resigns, go out and start selling the software on its own? What happens? So ARC and Co says, I will pay you 25 lakhs. You must not share the secret of the software. You must not share any secret about the software. For that, I will pay 25 lakhs. So that's what you're calling as not sharing any no patent. So please remember this abstaining, that is not doing anything for 2 reasons: not carrying out any activity, not sharing any know-how, patent, copyright that you have. So this is what is called as not doing anything. So that is what is there. Next is keyman insurance. So when you say keyman insurance, typically, I'm really sorry, I'll have to add one more point for abstaining. This concept of abstaining is not applicable for capital gain, which means, let's say this software is sold. Then whatever the rights of the CA software, rights of the CA software is sold to another company. So this selling of right will be taxable under capital gain, and hence this PGBP chapter is not applicable for that. So that's what we need to understand. And similarly, compensation for a fund received from Montreal Protocol. What is this about? Montreal Protocol is about climate change. So there is a separate fund in this Montreal Protocol. So any compensation from that fund to a particular organization, this is not applicable. So which means that is not taxable, which means that income is not taxable. So there are 2 exceptions to this, not doing anything. Okay. Coming back to the keyman insurance, any sum received under a keyman insurance policy. So what is keyman insurance policy? I'm again going back to the same firm, ARC. Okay, there are 3 partners, ARC. Now they are critical pillars of ARC and Co, right? So they are critical pillars of ARC and Co. So ARC and Co takes an insurance policy for these people. So for ARC and for 3 people, A, R, and C, ARC and Co firm takes an insurance. So this, who are the ARC? What can you call them? They can be called as key managerial person, that is KMP, key managerial person. So an insurance taken for these people, that is an insurance taken for key managerial person is called as key man insurance policy. That is why it is called as key man insurance policy. Any income, any sum received, so whatever, let's say sum assured, bonus, if something is received by ARC and Co for this particular money, it is taxable in the hands of ARC and Co. So whatever money received from Keyman insurance policy is taxable in the hands of the firm or that particular organization. So that's what it is about. The next instance that we are going to talk about is stock. We are going to talk about the stock. So what do you mean by stock? FME on the inventory on the date of date. So we'll take this example. Why do you, when does a stock becomes an income? So let's take another company. Till now we have been discussing only about ARC and Co. Now we'll take a new company. We'll call it as what? Day Limited. Okay, we'll call it as Day Limited. Now Day Limited is involved in real estate. So now some of the assets that they own, for example, let's say three properties is a fixed asset, which means they are using it for their own purpose. There are, let's say, 85 properties, which is kept as stock, which means they're ready to sell this. It is a stock to them. It is an inventory to them. So this 85 properties is a stock. So when this particular property is sold, it will be recognized as an income. Correct? We are all clear in that. There is no double thought on this. So when you have a stock, when you sell that, you treat it as an income. This is very clear. Now, Day Limited feels one property has to be shifted from stock to fixed asset, which means they feel that this one property should be utilized for their own purpose, should not be sold. So they're converting the stock. They're converting the stock into fixed asset. Okay. So they're converting the stock into fixed asset. So what are they doing? They are converting. So they are converting the stock into a fixed asset. So now this is like a sale. So please remember, this is like a sale. This is something like a sale. So this must be recognized as an income, correct? So this must be recognized as an income. How do you value this particular stock? So that's what is defined here. So it says fair market value of inventory. So in our case, it's a property. So the fair market value of that property on the date in which it is converted or treated as a stock will be considered as your sale of assets. So that's what it is about. So please understand, when a stock is converted into a capital asset, that is your fixed asset, when a stock is converted into a capital asset, the fair market value on the date of conversion will be considered as your income. So that's what it is about. Next is specified business. So what do you mean by specified business? There are specific businesses, something called as, we'll call it as infrastructure business. So there are list of business which are categories under 35 AD. So why is that listed here? In that business, that is specified business, you get 100% deduction. You get 100% deduction on capital asset. So when you invest in an asset, you get 100% exemption. Now, subsequently, when that asset is demolished, destroyed, discarded, or transferred, when that asset on which you have claimed deduction, so let's say the asset value was 10 lakhs, you would have claimed deduction, right? 2 years later, this is finally sold. This is finally sold for 3 lakhs. Now this 3 lakh is an income under section 28. Because you have already claimed it as a deduction, saying that I am doing a specified business, so please help me out. So government says you claim 100% deduction. Subsequently, when you are transferring that asset, whatever you receive is straight away taxable, which is because generally it is like sale minus purchase, right? So in this, purchase is like zero because 10 lakh has already been claimed as deduction. So purchase is like zero. So your sale is 3 lakhs. So the net will be taxed under section 28. So typically, to summarize, the business which is categorized as specified business under section 35 AD will straight away be considered as an income because it is an asset which has already been claimed as deduction under section 35 AD. It is already claimed as a deduction under section 35 AD. When you're understanding a provision, understand the logic behind why that provision exists. That's why I'm trying to explain you the reasons behind why that provision was put in place. So typically when we say stock, we understood why it came, right? So we understood why is it taxable. Similarly, here also we are trying to understand why is this taxable. So typically, this is taxable because it is an asset which was claimed as a deduction 100%. Generally, when you sell an asset, it is taxable under capital gain. But in this case, you have already claimed as 100% in your business itself as a deduction. So whatever you receive out of it is again taxable here. So the sale amount is straight away taxable. So that's what any sum on account of capital asset being demolished, destroyed, discarded or transferred is taxable under section 28 clause 7. So that's about your PGBP. So the last thing we are going to understand about section 28 is basically any compensation or other payment. So typically there is a person who's managing the whole or substantial whole affairs of an Indian company or any other company in India. So it's typically a company in India which is when they receive any money for termination of his management office or the modification of the terms and conditions. So typically there is agreement. There is an agreement between a person who's managing. So a person who's managing a business and the entity. So when they have a change in terms and condition, before just going forward, I'll just tell you all these clauses about change in terms and condition. When there is any change in terms and condition of a specific agreement, because of which you are being paid, it will be taxable under PGBP. So any money received for change in terms and condition is taxable under section 28. So we'll just see when all it is taxable. So basically, when a person who is managing, let's say a managing director is receiving money. We'll take an example of someone called MD. So MD of ABC Limited. Okay, he's an MD of ABC Limited. Let's say his name is what? R. Okay, so ABC Limited MD is R. Now, whatever ABC Limited, let's say ABC Limited managing the whole or substance, the whole of affairs in an Indian company or any other company in India. Now, this person, for whatever services you do, ABC is paying him, compensating him for managing a business. Okay, managing the business. Now, there is an agreement. For this. Now, this agreement is modified to benefit ABC Limited. So there are changes in the terms and conditions of this agreement. So when there is a modification in this agreement, for this change, let's say this person R is paying ABC 5 lakhs. Now, this is an income to ABC Limited. So, there is a change in agreement entered with R, who is actually controlling the organization ABC Limited. Now, when there is any change in this agreement, any modification, whatever money received by this ABC Limited will be taxable under Section 28. So, in short, when there is an agreement between two business people, any change in this agreement for which one company pays to the other company, this money will be taxable under business person. Similarly, an agency. So there is principal agent, right? Principal agent. So whatever this agency is receiving for any change in the modification. In our example, let's take principal agent. Now they have an what? They have an agreement. This agreement is the terms and conditions is modified, okay, for which 6 lakhs is paid by principal to agent. Now this 6 lakh is an income to agent under Section 28, Clause 2. So that's what this refers to. So holding an agency. So principal paying agent for any change. It could be termination also, change also. So termination or modification. And similarly, any organization, any two organizations, if one person receives from other organization, it will be covered under this section. And the last one is any person at or in connection with the termination of modification terms of any contract relating to his business. So if you want me to summarize this section, I'll summarize it. One person, two person, they have an agreement. Okay, it could be any two persons. Now this agreement is terminated or modified. For this termination or modification, if money is paid, if for termination or modification, if money is paid, then it will be taxable under PGBP under Section 28, Clause 2. Please understand, in short, any two persons having an agreement, it could be between a managing company and the other company, holding subsidiary or something, principal agent or any two organizations. When there is any change in the agreement or termination, agreement is terminated, then any money paid is taxable under PGBP under Section 28(2). So that's what this section is about. The next topic that we are going to cover is called speculative business. I will take some questions after this slide. Speculative business. So what is speculative business? Speculation. Okay, the normal English word called speculation. So what is it called? Speculation is basically result is not determinate. For example, let's take India versus England semi-final happened, right? So some say India will win, some say England will win, but no one actually knows the result till the last minute, right? Will not know the result till the last minute. So when someone says India will win, it's a speculation. It is a speculation. When someone says England will win, it is a speculation. Same way with anything like today's climate. Will it rain, right? Will it rain? So it is a speculation. Now, in all these cases, the result is unknown, correct? But what if there are some transactions where you do not know whether it will result in profit or gain, but you are speculating. So they are called as speculative business. So speculative business is defined under Section 43, Clause 5. 43, Clause 5. Now, there is something about this Section 43. Please remember, there is something about this Section 43. We said there will be a definition section in each of the act, right? So Income Tax Act, Section 2 of Income Tax Act is a definition section. Similarly, in Income Tax Act, in some of the chapters, there will be a section which will have definition for that chapter alone, So for PGBP, section 43 is definition section. So any specific definition for PGBP will be defined in the section called 43. So 43 is a definition section for the terms used in PGBP, which would not have been defined elsewhere. So that's what you call it as definition section for PGBP. So in that, the fifth definition, clause 5, that is the fifth definition, is about speculative business. So what does it say? A transaction which a contract for the purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by actual delivery or transfer of the commodity or scrips. So which means a business is called speculation when there is no actual delivery. So you're buying something, buying a security, a share or something, but you are not actually owner of that share. So typically, a speculation business is a business where there is no actual delivery. You don't own that. You have put money into that, but you don't own that. Please understand this. You have put money into that, but you don't own that share. So that is what you call it as speculation business. So this business must be separately computed. Why? Because losses from speculation business can only be set off or carry forward against speculation business. So you cannot adjust loss from speculation business with profit from other normal businesses. So this is what you mean by speculative business. So when you talk about this, we need to understand that some of the business are not speculative in nature. So one of them is hedging. So what do you mean by hedging? You enter into a transaction to mitigate a risk. There is a risk involved in foreign currency or whatever. So you enter into a hedging transactions to reduce the risk of this foreign currency loss. So same way with forward contract, trading in derivatives, trading in commodity derivatives. So if you are dealing in these businesses, then whatever you're doing in the speculation business, these are not speculative. Though there is no actual delivery here, it is still not speculative. So income tax has specifically stated hedging, forward contract and derivative. Hedging, forward contract and derivative are actually not speculative businesses, though there is no actual delivery. So that's what it is. And similarly, when a particular person runs a business whose primary activity is trading in share, banking or granting of loans and advances. So for these three transactions, if there is a business which is primarily engaged in trading in shares, banking or granting loans and advances, their business is not speculative in nature. So please understand, speculative has been defined as a transaction where there is no actual delivery. And such business should be independently calculated because the loss from that business cannot be adjusted with other businesses. So that's what it is about. And there are some transactions which are specifically not speculative, that is hedging, forward contract, trading in derivatives, and if their primary business itself is trading in business, banking and granting of loans and advances. So this is what it is about, speculative business. So I will answer some of the questions for a few minutes and then we'll take a short break. Yeah, Kavita. Charging sections are separate for each of the chapters, that is salary, house property, PGBP, everything. Some of you have named the perquisites, Dhyanesh, Harini, Shivlani, and Abdul, Arshit. So all very good. So you have all named various perquisites. I came out with only a couple of examples, but you have given so many examples. DNA is all good. Jyoti, duty entitlement passbook scheme. I think we will limit this explanation So you are doing an export, government is saying, because you are doing an export, I'll give you some duty drawback, which means you have given me some duty. You have paid me customs duty or you have paid me excise duty. I'll give you back some part of it. So that duty drawback is an income. So let's not go into this because it becomes an indirect tax topic. So for income tax purpose, please understand any duty which is given back to you for the purpose of export will basically called as a income. Is an income under PGBP. Yeah. So, who's key managerial person? Kavita, I think I've explained. So, basically, directors, partners, CFOs, CEOs, all of them will be the key managerial person. Insurance claim receipt for loss of stock is taxable? Yes. But there, it is like an income itself. It's like a sale. So, whatever insurance money you receive is basically taxable. Nikita, fair market value is typically the value of that property on that day. When you say fair market value, today we'll take an example, an iPhone 14 Pro, right? An iPhone 14 Pro. What is the fair market value? Whatever is the price, it is available in the store. So whatever money you get in that store is what is called as a fair market. So fair market value is a trade value on that particular market, in a market. So that's what you call. Kavita, my handwriting is actually very bad. I'm literally sorry. What could happen is probably when I upload these notes, when you're actually looking at it again, you might know. I'll try to make it little legible, but I'm really sorry. I have a bad handwriting, so I can't actually help it. I'm really sorry. But when I upload the notes, I think when you keep looking into it, you will definitely understand it. Nikita, yeah, speculation is about deciding or forecasting. So we listed out what is speculation, what is not speculation. Wagering agreement is not speculation. No. Whatever is speculative is speculation. So whenever you talk about an agreement where happening or not happening is not clear, it becomes speculation. What are specified business 35AD? We will cover it in detail in a separate slide. For right now, what you need to understand is whatever income you are receiving from transfer of asset, of which has claim deduction under 35AD will be treated under PGBP. 35AD includes specific business where you claim 100% deduction on capital investment. Pranav, key man insurance policy is also given in salary, is also given in PGBP. How do you differentiate it? It's actually a good question. Basically, key man insurance policy in salary is from the employee's point of view. It is like a perquisite. It's like a perquisite to that employee. So whatever benefit they are getting out of it is like their own income. So that's what it is about. Here, what we are talking about is the money received. The money received as sum assured or whatever from the insurance person to that particular organization, then it becomes a PGBP. So money received from a key man insurance policy provider is taxable under PGBP. There, when it is received by the employee, it is taxable in the hands of employee. Here we are talking about when it is received in the hands of the employer. So that's what it is about. Abdul, how do we determine FME when we are only in that business? Income tax provides methodology to compute fair market value, which you learn in final. For now, you only have to remember the concept of fair market value. How do you compute fair market value for various assets? You will study that in final. Arshit, please explain section 28(3)(d). 2D, okay, yeah. As I told you, I think I already explained for earlier. I am not going to talk about what is this duty entitlement passbook scheme. I'm not going to talk about it because it's for your good. for two reasons. One, it is a topic related to indirect tax. Second thing, what is relevant for your examination is any drawback, any duty which is given back by the government to you for doing export. There are various schemes for that. One of them is what is listed. So for you to, for examination purpose, please remember any duty given back to you by the government, any duty given back to you by the government for the purpose of export is basically treated as an income. So that's what it is about. So with this, we'll take a small 5-minute break. We will probably resume the session after 5 minutes with the subsequent slides. Thank you. So we'll take a short 5-minute break. Yeah. So yeah, welcome back. So we were discussing about, so far we have discussed about the basics of the concept. The reason why we stressed it so much is basically you need to understand the concept of ABP. So we discussed about what all will be called as business profession, and then we also discussed about what all are about the charging section. So basically we discussed about all that, and then we also understood about the concept of section 28, that is a charging section, what all will be listed out there. Finally, we discussed about the speculative business. Okay, so with that, we'll move into computing this business and profession. So when you say income tax, and when you talk about the heads of income, what is more important is about how do you compute? How do you compute the income? So as we said, we will understand what is taxable, when is it taxable, how much of it is taxable. So we are going to, we understood what are all the income that is taxable under PGBP. So as we told, as we were discussing, we'll understand the concept of this computing. So when we say computing, we are going to understand, we understood about the charging section of what are all the incomes that is computed. Now we need to know what are all the expenditure, that will be allowed, The first thing that we are talking about here is the structure, how we need, what is allowed and what is not allowed. So this is discussed in section 29. So what does section 29 say? It says, first allow expenditure which are covered under section 30 to 37. They are called as admissible deductions. So we'll learn that. Then we need to know what are all not allowed, that is disallowed. What are all disallowed, that is covered under section 40, that is called inadmissible deductions. The next is covered under section 40A. They talk about expenses that are generally allowed, but disallowed on certain situations. So this is also about disallowing, but not every time, only on certain circumstances. So difference between 40 and 40A is 40 is disallowed, straight away disallowed. 40A is disallowed only on certain circumstances. So that is 40A. Then about 41. 41 is an income. Income which is not covered in your books of accounts. So what are all the profits that are chargeable to tax? We will call it as deemed income. What are all the income that will be treated as deemed income? So that is discussed in section 41. Then you have 43B. Which is basically allowed on payment basis. So this is also about disallowances. So 43B talks about an expenditure which is allowed only when paid. So which means when you have not paid, it is disallowed. Now, when you remember this, when you read this word called payment basis, allowed on payment basis, income tax said you can follow both cash or mercantile system of accounting. But section 43B only allows on payment basis, which means only on cash system. So even when you are following mercantile system of accounting, some of the expenditure is allowed only on payment basis. So this is what we are going to discuss in section 43B. So now the structure is, I compute all the income under section 28. So I compute all the income under section 28. Then allow expenses which are covered under 30 to 37. Disallow, that is not allow expenses covered under 40, 40A and 43B. Then treat it as deemed income under section 41. So after doing all this, you finally get your PGBP, what is taxable as PGBP. So that's what you cover. So now we are going to discuss about each of these sections. What does 30 say? What does 31 say? So from everything 30 to 43B, we are going to discuss about each of these sections. We'll start with section 30. Okay. We'll start with section 30. So 30 talks about, 30 is one of the admissible deductions. So 30 talks about rent, rates and taxes, repairs and maintenance, insurance. Please remember there are 4 expenses. So rent, rates and taxes, repairs and maintenance, insurance. So these 4 expenses for what? For what? For building. So any rent expenditure, rates and taxes, repairs and maintenance, insurance for building is covered under section 30. So these are the things that we are going to understand. We'll first consider rent and repairs. Okay, we'll consider rent and repair. So when it comes to a building, okay, when it comes to a building, I could either be owner of the building, I could either be the owner of the building, or someone else be the owner. I am paying rental. So I am a tenant. So I could either be the owner or the tenant. Now, whatever rent you pay as a tenant, whatever rent you pay to the owner is an admissible deduction under section 30. When you say rent, there could be a scenario where building is owned by the partner, firm is paying rent. Building is owned by the partner, firm is paying rent. Is this allowed? Not allowed? Yes, allowed. Yes, allowed. But the word is, it should not be excessive. What do you mean by not excessive? We'll recollect your house property. There are 3 types of rent that you compare. You compare to arrive at what? To arrive at your gross annual value, correct? To arrive at your gross annual value. So you identify what is fair rent, municipal rent, standard rent. Okay. These are all fixed by the government on various circumstances. So fair rent, right? So there is a concept called fair rent. So what is fair rent? What is typically paid in that locality? What is typically paid in that locality? Something like your fair market value, FMV. So when it is paid to a partner, it should be made sure that the rental paid is something like a fair rent. That is, whatever is supposed to be paid in that area, only that rental should be paid. So anything excessive will not be allowed. Whatever is the reasonable rent of that locality, what is called as reasonable rent, something like fair rent is what could be called as a fair, reasonable rent. So only that rental is allowed. Next concept is repair. As a tenant, when I'm doing any repair charges, I can claim it as an expenditure, provided it is not capital in nature. Not capital in nature. Very simple, right? I don't think we should study anything to remember this, because we are talking about expenditure which is set off against the income. There are some income, there are some expenditure. So when I'm talking about these expenditure, it can only be revenue in nature. It can never be capital in nature. So the expenditure I'm talking about can only be revenue in nature, cannot be capital in nature. So whatever revenue expenditure that is being spent by the tenant can be claimed as an expenditure. Of course, if the owner is paying, let's say the owner is it's a very genuine person. The owner says, see, I am happy to have you as a tenant. You need not spend 1 rupee on expenditure, irrespective of there is a problem in your pipeline, irrespective of whether there is a problem in your electricity, whatever happens, I will make sure I spend it for you. You don't please spend 1 rupee also. Even if you spend it, please let me know how much you spent. I'll give it to you. Let's say you have an owner like that. How difficult, right? In these days, I don't think you can ever get an owner like that, saying that you need not spend anything. I will spend everything for you. Assuming that there's an owner like that, this tenant is not incurring any repair expenditure. Even if he's incurring, he's getting it back by the owner, which means it is not his expenditure. So he cannot claim. So very simple. Only if I spend, I can claim. If I don't spend, I cannot claim. So that's what it said. So when you say you must have incurred that expenditure. So only what is borne by the assessee alone can be considered. So whatever is borne by the owner cannot be considered. whatever is borne by the tenant is only should be considered. So that's what it is about. And this is when you're staying in that property as a tenant, if you're running business as a tenant. Now, what if you're owner of that property? You're owner of the property, whatever is the current repairs, that is again, whatever is the revenue expenditure in repair is what should be considered. Whatever is capital should not be considered. As I told you, I don't think I need to explain you this, because any expenditure to be claimed as an expenditure can only be a revenue expenditure, because you generally can't claim capital expenditure as a expenditure against your income. So it is very straightforward, very simple. You need not remember anything. Whatever is the current repair alone can be claimed. So that is when you are occupying the property, when it is your owned property. So as we said, there could be two types of property. So when you say a building, you could be a tenant. You could be a tenant, or you could be a owner. Correct? When you say tenant, rent and repair. When you say repair, it is what? It is revenue in nature. Similarly, when you say your owner, whatever repair. So when you say repair, what? It is revenue. Revenue repair. Right? So this repair alone is considered. So a building could either be owned or you could be a tenant. If you're a tenant, you're additionally eligible for rental. If you're owned house, you can't pay rental to yourself. So in that case, only the revenue is allowed. So when you are a self-individual doing a proprietary business, you cannot pay rental to your own self. So that's why rentals are not allowed for occupied and owned property. The next category, we said there are 4 expenditures allowed. We have already covered rent and repair and maintenance. Now we'll come to rates and taxes. As far as rates and taxes is concerned, it could be any taxes collected by the government. So it could be land revenue, or it could be a local rate, or some municipal taxes. It could be any taxes, water, whatever it is. Water tax, anything collected by the government for that building will be called as rates and taxes. The only thing that is important in this rates and taxes is it not only includes Indian rates and taxes. If it's something levied by the foreign government, that is also allowed. Why do they specifically include foreign government's local taxes? Because let's say I have an office in Singapore. There I am paying some rates and taxes to that Singapore government. Now this is also my business expenditure in India. So whatever taxes, rates and taxes I have paid to the building in Singapore is eligible as an expenditure here in India, because it is my office, my business is happening, my income generated from there is reported here. Correct? So whatever it is, even if it is foreign government, it is allowed. So that's what it is about. The last one is insurance. When you say insurance, if you actually look at it, insurance is allowed only for a specific reason. The premium paid against insurance for what risk? Damage or destruction of property. So if you're insured the property for damage or destruction, when you tell this, just think over and see what are the other reasons you could probably insure your property. Apart from damage or destruction, there could be some damage or destruction to the property for which you have insured. Apart from this, let's say you have taken a loan on that property. You are taking a mortgage insurance. You are taking a mortgage insurance on that property. So if something bad happens, your mortgage insurance will repay your loan. So this could also be on the property, right? So the point here I'm trying to convey is not any insurance, only insurance that is because of damage or destruction alone is considered as your expenditure that you can claim under section 30. Those are admissible deductions. Please understand, we are only talking about what is covered under section 30, not what is generally covered. So we are only talking about what is covered under section 30. What is covered under section 30? Rent, rates and taxes, repair and maintenance, insurance. So we all know RRR movie, right? So there is movie. It is definitely a pan-India movie. So I'm definitely know. We all know, right? So RRR. So what does this R stand for? Rent. What does this R stand for? Repair. What does this RRR stand for? Rates. So these three are the expenditure that are allowed on buildings. So RRR, we all know this movie. So rent, repair and rates are allowed in things. When you say repair, repair and maintenance. When you say rates, rates and taxes, that's what we are calling about. And apart from this, insurance. Apart from that, you are also eligible for insurance. So RRR and insurance. So this is what is basically what is allowed under building. Okay. Now, sometimes we said I myself am the proprietor. I have a two-floor building. Ground floor is my office. First floor is my residence. Now, if there is any repair expenditure for the building as a whole, if there is any expenditure of the building as a whole, how much can I claim for my business? How much can I claim for my business? I don't think I should explain this. I think most of you would have come out with the answer right now itself. So when I have two-floor, ground floor is business, first floor is residence, I'm incurring a repair expenses. How much should to be considered as a business expenditure? How much? I'm very sure almost all of you would have considered without me explaining the provision. So the concept is proportionate expense. Proportionate expense. This is discussed under section 38.1. This is discussed under section 38.1. So what does it say? When there is a business expenditure, whatever is proportionate, consider that alone, which means if I have spent 20,000 and I'm for a two-floor building where only one floor is occupied for business, half of it, 10,000 is business, 10,000 is personal. So what is allowed under section 30 is only 10,000. So that's what we are talking about, proportionate expenses. So that is section 30. So we'll move on to section 31. So when we first discussed about, we only discussed about building. Now we are going to talk about other assets, machinery, plant and furniture. So we are going to discuss about other assets which are discussed in section 31. So same thing. Here, we are only talking about repair and insurance. Why? Because, of course, for machinery and plant, there are not going to be any rates and taxes. There might be rental because you are renting out a machinery or you are renting furniture, but that is not covered under section 31. So, in that same concept that we said, we spoke about RRR, right? We said rent. It is covered in 30. It is not covered in 31. Repair is covered both in 30 and 31. Rates, it is there in 30. It is not there in 31. Why? Because there is no rates and taxes. So it's not there. And same way, insurance is covered in both 30 and 31, correct? So this is how you remember. So now coming back to that, what is the eligibility to claim this? The only thing is the asset for which you are claiming repair or insurance, should be used by the assessee. Please understand the term used by the assessee for the purpose of business. Now the word used is very critical. Because it includes passive use as well as active use. So what do you mean by passive use? Which is basically, let's say I am in the business of renting out cars. Now the car is me, the car is owned by me, but I am not using it. I am letting others use. Please understand, I am letting others use. So I am not using, but I am letting others use my property. Most of you would have heard about Zoom cars who allow you to rent cars from them. Let's say someone who's giving you that car there, is the owner of the car, but he is not using the car. He is not using the car. He is letting someone else use the car. So now the point here is when you say used, it includes passive use as well as active use, which means I must be owner of the asset. It could be me using, or my business itself is letting others use. So I'm still eligible for claiming expenditure under this section. So as we said, it is repairs are eligible. When you say repair, it should only include revenue repairs, not the capital expenditure. So when you say capital expenditure, anything which extends the usage of machinery. For example, if the machinery has a capacity of manufacturing 1,000 units. Machinery has a manufacturing 1,000 units per day. Now I'm doing some changes to that machinery. Because of it, that machinery can manufacture 1,500 units per day, which means I'm expanding the capacity of the machinery. That is like replacement or reconstruction. That is not revenue. That is not revenue. Repair is something. 3 screws of the machinery has gone bad. Because of this, there is extra shake. I am changing the screws, which is repair. So which means it's just some keeping it in a running condition, proper running condition, without changing the capacity of the machinery, So that's what you call it as renewal or renovation is there, but not replacement or reconstruction. So that's what it is about. So current repair is around. And insurance, what did we say in building? For what all you can claim insurance? For 2 things, right? Damage or destruction. So for damage or destruction, if you are making any insurance, you can claim that. So the risk of damage or destruction is what is allowed. So whatever is premium paid will be considered. Whatever it is there. So that's what we are calling as insurance. So when you say premium paid in cash system and will include payable in case of mercantile system. I don't think I need to explain this because mercantile system, irrespective of whether you have paid it or not, moment it becomes payable, it is allowed as an expenditure. So that's what it is about. So as we said, for machinery, plant and furniture, only repair and insurance is allowed. Repair must be revenue in nature, not capital in nature. Insurance should be for damage or destruction, not for anything else. So this is about machinery, plant and furniture. Insurance of machinery, plant and furniture. So now I'll take up some of the questions on these sections till now. What is the logic of taxing capital gain of sum received on account of capital asset under section 35A? It should rather be taxed under capital gain. Subhashis, I will actually explain this in 35AD itself, but since it is a question on section 28, I'll explain it. See, what we are trying to say is, in 35AD, I am eligible for 100% deduction on capital asset. Okay, I am eligible for 100% deduction. So, moment I claim 100% deduction, my value becomes nil. So I am not claiming any depreciation. It's not my fixed asset also. It's not a depreciable asset also. So typically, since I'm not claiming any depreciation, I'm immediately making it zero. It will not come under my fixed asset itself. It will not come under the concept of capital asset. Since it is not a capital asset, any income earned during the transfer is not taxable under capital gain. Any income received that time is not taxable under capital gain. So that is what we are actually calling it as taxable under section 28 and not under section 30, your capital gain chapter. Reason is, moment you claim 100% deduction, the value of the asset becomes nil. Which means the value of capital asset is zero. Which means it is not a capital asset. So any transfer from this cannot be taxed under capital gain. That is why the receipt because of transfer of that particular asset is taxed under PGBP itself. PGBP itself. That's what it is about. Hope I have answered Subhashish. Abdul, first time deposit in rent is admissible. The rental deposit is a balance sheet item. It is not a P&L item. It's an asset. Whatever security deposit of rental is an asset. So that's not admissible. Whatever you are calling about is monthly rental or periodical renters paid. Alok, Dianesh, you have come out with that. Whenever I said I need not explain you about proportionate expenses, you have come out with the answer of saying that it is proportionately allowed. Good. Kavita, yeah, rent is not covered under section 31 because probably when the act was framed, the concept of renting out furniture or plant and machinery would not have been there. I don't know. However, as I told you, we are only talking about what is covered under this section 30 and 31. Rent paid to plant and machinery could be covered under some other section. We'll see that subsequently. For now, it is not covered under section 31. What is covered under section 31 is only repair and insurance of that particular machinery or plant or furniture. So Mohammed, about speculative business in short, it is a business where you try to make short profits. You try to make short profits, immediate profits, but just huge risk involved in it. Huge risk involved in it, where you actually don't buy anything, but you invest. Please understand, you actually don't own it, but you buy something. So you are not owner of the share. You don't buy that share, but you still pay money for trading in that share. So that is what it is called speculative. Speculative is something where you are doing it for a very short period of time to make profits. You are speculating the transaction itself where there is no actual delivery of the share or security. So that's what it is about. Pranav, what if you are not claiming 100% under section 35 AD? It is a mandatory section. Moment you have purchased an asset when you are doing a business under 35 AD, you need to claim 100% deduction. If you have not claimed, it is a depreciable asset which will be taxable under capital gain. Abhishek, insurance on building. I'm not sure what should I explain there. So basically, insurance premium on building for damage or destruction. For damage or destruction is covered. For any other purpose, it is not covered. Please understand, damage or destruction. If you are taking an insurance for damage or destruction of the property, only that is covered. Yes, as Pranav said, probably we could also classify a speculation business like a gambling business. Gambling business, that's another word probably we can use. It's like gambling. So that's what speculation is about. Yeah, good, Pranav. With that, we'll move on to the next section, which is section 32. Section 32 talks about depreciation. Go back to your 11th and 12th standard accounts. So what is about depreciation? What is basically depreciation? It's about what? I'll see whether someone of you are answering. So what is depreciation? So depreciation is typically about wear and tear. Wear and tear of that particular asset. So whatever asset is being used for the purpose of business, since there is any, whatever you're talking about here as the wear and tear of that particular asset, so that is what you're actually calling it as depreciation. So the cost provided to that wear and tear is what you're calling it as depreciation. Now, section 32 allows depreciation so that the value of asset comes down because it is being used, right? So there will be a useful life, right? So there will be a useful life. So particular asset, let's say the life of that asset is 3 years. You are going to depreciate that asset for 3 years. If it is 5 years, you are going to depreciate it in 5 years. So this is what you're actually calling as a useful life of asset. So, and it is compulsory. You cannot say, see, I think my asset will never depreciate. I can use this asset for 120 years. So I'm not going to depreciate. So that's not an option at all. It is compulsory. It is compulsory even if it is not accounted. So that is what it is. So income tax depreciation is compulsory even if it is not provided in the books of accounts. So that's what you're actually calling as depreciation. Now there are three rules to claim this depreciation. So you cannot claim it on any asset. There are three rules on claiming depreciation of the assets. The first thing, it must be a specified asset. What is the word of specified? Which means it must be a listed asset. It must be an asset specified under the Income Tax Act under Section 32. So that's a specified asset. Second thing is, it must be used. Please remember the word used. Where else did we you understand this concept of used? Where else did we understand this concept of used? We understood in Section 31, where we spoke about eligibility of claiming repairs of an asset, repairs and insurance of an asset, where we said it is allowed for the person who's using it for their business. So we understood that it is not only passive use, it is not only active user, it also includes passive use. So typically the same concept will apply here. Anyways, we'll see that in detail in the subsequent slide. So typically the second rule is it must be used for the purpose of business or profession. Third one is it must be owned. When you say ownership, it could be wholly owned or partly owned by the assessee. So these are the three rules. What are the three rules? It must be a specified asset. It must be used for the purpose of business. It must be owned by the assessee, either wholly or partly, but it must be owned by the assessee. So these are the three rules for that particular property, correct? So now we'll understand all these three independently. What is a specified asset? What does it mean by used for the purpose of business? What do you mean by owning an asset? So we'll understand all these three concepts. So the first concept is what? Specified asset. So the first concept is specified asset. So an asset must be a specified asset under the Section 32. So what are all listed? So asset can be broadly classified as tangible, intangible. So you have two concepts, tangible assets, intangible assets. So what do you mean by tangible assets? So typically tangible assets are something which can be what? Which can be touched and felt. It has a shape, it has a design, it has a structure. It is physically visible. It is physically visible in front of you. That is what is called as a tangible asset. So what are all the listed tangible assets? Building, machinery, plant, furniture. Please understand what is not listed here. Land is not listed here. So what is listed is building, machinery, plant and furniture. Land is not listed, right? So what do you mean by building, right? What do you mean by building? Building refers to the superstructure on the land. It only refers to the superstructure, but not the land. Whatever is on top of the land, not the land. So that's what is covered under building. So now building also includes roads, bridges, culverts, wells and tubewells. What is culverts? It's also like a small water passage or something. So all these things are actually called as buildings only. So though it is something more than a building, it is still considered as building for the purpose of Income Tax Act. So the roads, bridges, culverts, wells and tubewells are also called as building. So all these are called as building. Now the next thing is plant. What is a plant? Probably in biological term, plant is something what? Which grows, right? Leaves, all these are called plants. But when you say plant and machinery, it gives a different term. So when you say plant, it's typically something like a machinery only. So just that The plant is also defined under section 43, clause 3. What is section 43? What is section 43? 43 is a definition section of PGBP. Definition section of PGBP. We already saw something else. What did we saw? We saw 43 clause 5 defining speculative business. 43 clause 5 defining speculative business. Here we are talking about definition of plant. Is defined under section 43 clause 3. So 43 is a definition section. So plant, it says it includes ships, vehicles, books, scientific apparatus, and surgical equipment. So these are all included in plant, but does not include tea bushes, livestock. That is like something like animal, right? Building, furniture, fittings. So why is building excluded? Why is furniture fitting excluded? Because it is already covered in building and furniture and fittings as a separate category of furniture. So it is excluded from the plan. Since there's a specific clause for building and furniture and fittings, it is excluded from the plant and machinery. So even if you are a real estater, even if you are in the business of real estate, buildings can never be considered as a plant. It should only be considered as a building. So it can never be your plant, building and furniture and fittings. So now there are also other exclusions such as animals can never be considered as plant, human body can never be considered as a plant, stock can never be considered as a plant because of course it's a stock, it's a trading asset. So it can be not categorized as a fixed asset. So all these are not plant and machinery. So what do you mean by plant? It only says it includes ships, vehicles, books, scientific apparatus, and surgical equipment, but does not include tea bushes, livestock, building, or furniture and fittings. And it also does not include animal, human body, and stock. So that's what it is about. Plant is about. So these are all called as specified tangible asset. Buildings, machinery, plant, and furniture. We discussed about what is referred as building. We also discussed about what is defined as plant under section 43, clause 3. Now, moving on, we need to understand about intangible. We said tangible is something that is physically visible, touch, felt, it has a structure, it has a design. All that is what we are calling as tangible. Now, what is intangible? Exactly opposite of it, right? You all would have been expert by now on what exactly is intangible about because you would have studied for ages. Now, at least for the last 3 years, at least, you would have got used to this concept of intangible. So the intangible is something which is not felt, which cannot be touched, which does not have a physical structure, which does not have a physical design. So these things are called intangible. Something virtual asset, right? Something which exists, but it's not, you could not see it. Now, what are the intangible assets? Know-how, patent, copyright, trademark, license, franchise, any other business or commercial right of similar nature. So, which means they're including everything. They're only excluding one thing. They say it is goodwill. So, goodwill is not an intangible asset. So, what do you mean by that? So, they are specifically listing out few things, such as no patent, copyright, trademark, license, and all these things. And they are having a disclaimer clause to say that any other business or commercial rights of similar nature is also called as intangible. Just that goodwill is excluded from this because over the years, goodwill was also considered as intangible. Recently, in Finance Act 2021, goodwill was not considered as an intangible asset. So, goodwill is no more an asset on which you can claim depreciation, which can be treated as intangible. So, this is what is about tangible and intangible asset. So, this is what you call by specified asset, right? Specified asset on which depreciation can be claimed. Okay. Moving on. The second concept of the asset, we said it must be used. It must be used. When we said used, we said what? We said it must be used by you, or used by you for the purpose of business, or you should let others use. Let others use. We saw Zoom cars as an example, right? So you should let others use. So that is also your asset only. So you need not use it for your own business. Your business itself could be letting others use. Whose business will be letting others use? It will be the hire one who gives it on rent. So whose business itself is leasing out. So that is what it is about. So what does it say? The asset must be put to use. So it must be actually put to use. So in that case, the amount of depreciation, as far as income tax is concerned, when it comes to Companies Act, when it comes to your accounting, depreciation is proportional. Like in this year, if you have the asset for 100 days, I provide depreciation only on 100 days. If you have purchased the asset today, that is 15th November, what happens? The depreciation can be claimed from 15th November to 31st March. So it's like 15/11/22 to 31/3/22. So that's what is the accounting principle. Correct? But when it comes to income tax, it is not proportionate to the period of use. Then what it is? It is either full or half. Either you provide whole year depreciation or you provide half year depreciation, depending upon a cutoff date. We'll see that in the subsequent slide. So typically, that's how you provide depreciation. So now this must be used. So depending upon the put to use date, you either treat it in full or you treat half of the depreciation. Now, depreciation shall be allowable even in the following scenarios, even if the assessee is not using the asset. So what situation? The first is, it is actually utilized by another person. I have rented a car. His business is to rent out cars. So which means even if the car is used by me, the car is technically used for his business, because the asset is recorded in his books of account. I am only paying rental. It is not my asset. It is only his asset. So he only can claim depreciation. That's why the example of lessee or licensee. So the asset which is actually owned by someone, they only can claim, even if it is not used by them, because their business itself is letting others use, right? So that's what it is about. So that's what we are calling here also letting out on hire. And the third category we are saying is passive usage, which means it is actually ready for use. Let's say for my business, I have two machineries. One running, one idle. Now, this idle machinery will be used when that running machinery goes on fault, when it has to be given for repair, when it will take several days to come back. So, the second idle machinery will be used only when the other machinery is not in use. When the other machinery is facing some issues, some defect. So now what happens? This idle machinery, even if it is not running throughout the year, it is still eligible for depreciation, because it is ready for use. So that's how you claim depreciation. It's not about usage. Even ready for use assets is eligible for depreciation. It's not only when you use the asset, even if your business is letting others use, you are still eligible for depreciation. So that's the concept of usage. Remember, we also discussed about the concept of used in section 31 when we are discussing about repairs of building plant and furniture. So that's what it is about. So that is about usage. What is the third condition we set for depreciation? We said it must be owned by the assessee. It must be owned by the assessee. So it must be owned by the assessee. So when you say owned by the assessee, he should be the legal owner. He should be the beneficial owner. It doesn't matter whether he is wholly owning or partly owning the asset. So it doesn't matter. So what matters is he must own the asset. Even in leasing the asset, if you actually look at it, the owner of the asset is the one who actually owns it. The other person is only using it. So he is not the owner of the asset. So even in that case, the depreciation can be claimed only by the person who is actually owning the asset. So that's what it is about. Clear? So that is about usage. Now, so that is about 3 rules. We said specified asset used for the purpose of business, wholly or partly owned by the assessee. So these are the 3 conditions. Once you have satisfied these 3 conditions, once it is decided that is specified asset that is used by the assessee, it is owned by the assessee, you can provide depreciation. Now, how do you provide depreciation? How much do you provide depreciation, right? We know what is it? You provide depreciation. When should depreciation be provided? In that year. Every year you provide depreciation. How much you should provide for depreciation? For that, you should know the method in which you can claim depreciation, rates for which you can claim depreciation. We'll first understand the method of depreciation. When you say method, again, I'll take you back to the old asset, old concept of 11th, 12th accounts. What are the methods of depreciation that you can provide? You can provide straight line method. You can provide written down value method. So you can only provide these 2 methods. So income tax recommends written down value method. Income tax provides written down value method. But if it is in the business of power, distribution or generation of power, then depreciation can be provided on straight line method also. So power generation unit will provide depreciation on straight line method. Every other business will provide on written down value method. So power generation units can opt for WDV in the first year of operation, can opt for the depreciation in the first year of operation before the due date of fair. So they have only option once, which means the first year of depreciation, they can choose WDV or straight line method. Once they have decided that method, they cannot change that method. So that's only once. It can never happen. So that's what this is about. And we said about additions, it is not proportionate. There is a time limit. So the time limit is 180 days. So if as an asset is used less than 180 days, you provide 50% as depreciation. So in the first year, if it is less than 180 days, you provide 50%. If it is more than 180 days, you claim full year depreciation. We said full or half. So if it is less than 180 days, it is your 50% of depreciation. If it is more than 180 days, then you provide full year depreciation. So that's what it is about. So depending upon that, you decide. So you decide what will be the 180th day and you take into consideration. So if you want to consider 6 months, it's like September, right? So 30th of September, since your February has only 28 days or whatever, depending upon the year, type of year, leap year or whatever, it will be 1st or 2nd October. 1st or 2nd October will be considered as your 180th day. So if it is after 2nd October, it will be less than 180 days. If it is still 2nd October, it will be considered as more than 180 days. So that's what it is about. So that is about additions during the year. So we said it will be restricted to 50% of depreciation. Now we need to understand the other concepts of depreciations. So when we said depreciation, there is some usual rates, whatever is allowed for depreciation. For some assets alone, for some businesses alone, additional depreciation can be provided, which means apart from your regular depreciation, you can provide additional depreciation. Apart from your your regular depreciation, you can provide for additional depreciation, right? So that's what it is about. Now, what are the conditions to satisfy for that? First is it must be new. That is, you must have purchased the asset only now. Only now. It only excludes ships and aircraft. So you must purchase plant or machinery. Please understand, it's not for any other asset, not furniture and fittings, not building. It is only applicable for plant or machinery. So if you are purchasing a plant or machinery and you are engaged in the business of manufacturing or power distribution or generation, if you are in one of these two businesses, you are either manufacturing or generating or transmitting or distributing power, then you are eligible for additional depreciation. When you say manufacturing, printing or publishing is also considered manufacturing. So when you said type of business, manufacturing, printing or publishing, generation or distribution of power, all these are considered as manufacturing businesses. And how much is allowed? So how much is allowed is 20%. So apart from whatever depreciation rate you are eligible, you give additional 20% in the first year alone. Only in the first year, you give additional 20% depreciation. But if it is less than 180 days, of course, what do you provide? Only half, right? Half the depreciation. So half of 20% is 10%. The balance 10% will be claimed in the next year. So please understand, additional depreciation is provided for new plant or machinery purchased, but does not include ships and aircraft. And it is eligible only for the assessee who's engaged in the business of manufacture, print or publishing, power generation, distribution or transmission. Only for these persons it is eligible. How much is eligible? 20%. But if the asset is used less than 180 days, you can only claim half. So half of 20 is 10. You need not remember it like a number, 20, 10. You need not remember it like a number. Moment it is less than 180 days, you can only claim half, which means half of 20 is 10. So that's what it is about, additional depreciation. Now, on these assets, which is less than 180 days, you have claimed 10% now. The balance 10%, you can claim it in the next year. So in the next year, even though it is not a new asset, you can still claim that additional 10%. So that's what it is about. So if you are purchased asset, we'll take today as the date. We'll say we are purchasing an asset on 15th November 22 for 2 lakhs. We are purchasing a machinery. Now it is less than 180 days, right? So it is only eligible for half depreciation. Since it is an additional depreciation, you are eligible for how much? 20% into 50%, because you're eligible only for half. So 2 lakhs, 20% is 40,000 and half of it is 20,000. That is nothing but 10,000. So 20,000 is provided in which year? That is additional depreciation of 20,000 will be provided in financial year 22-23. In financial year 23-24, you will claim the balance 20,000. Because you are eligible for 20%, since it is less than 180 days, you have claimed half in 22-23, the balance half in 23-24. So that's what you call it as additional depreciation. Now, even if it is a plant or machinery, it is not allowed on certain situation. Even if it is a plant or machinery, new plant or machinery, it is not allowed on certain situation. What are they? It is an used asset in or outside India, which means it is a used asset, second-hand asset. If you are purchasing a second-hand asset, it is not allowed. And it is a plant or machinery installed for office or residential accommodation. So let's say it is installed in guest house of the office. If it is installed in an office, so manufacturing happens in a factory, you also will have an office premises. So if the asset is purchased for office premises, it is not allowed because it is only eligible for what? Manufacturing or power distribution. So only for that use that machinery should be used. So it is not allowed for office purpose or something. And similarly, the next category is it should be 100% of actual cost allowed as deduction. Let's say in one of the section, like 35 AD, where we said 100% will be claimed for that asset, additional depreciation will not be allowed because 100% of deduction has already been claimed. So wherever 100% has been allowed as deduction, you cannot claim additional depreciation on that because the cost of the asset itself is zero because you have provided 100%. And also, it is not applicable on office appliances or road transport vehicles. So the vehicles which is used to transfer goods from one location to another location, it is not something like your lorry, your goods vehicle or whatever, road transport vehicles, it is not allowed. And it is also not allowed for office appliances. What is office appliances? Something like your air conditioner, refrigerator or whatever it is, are called as office appliances. It is not allowed on these assets also. So additional depreciation is not allowed on any assets installed in office premises, residential accommodation. It is also not allowed for office appliances, road transport vehicles. It is also not allowed for used assets, second-hand assets. It is also not allowed for assets which has already claimed 100% deduction. So these are the 6 situations where an asset cannot claim additional depreciation, cannot claim additional depreciation. Clear? So that's what it is about. Now, what are the rates? We said depreciation. We need to understand how much has to be provided. We know WDB method. We know additional depreciation. We know 50% only has to be provided if it is used less than 180 days. All that we know. Now we need to know what are the rates. Now I have listed out not every asset. I have not listed out every asset. I have listed out only assets that are important for your examination, that are actually relevant for your examination. The other thing, there are plenty of assets you can very much go through, but please understand these are very critical. So if it's building is like block 1. So building includes residential, other than residential, some wooden structures and other thing. So it is at 5, 10 and 40% respectively. And with respect to the other category, furniture and fittings, so it includes electrical fittings. So whatever electrical fittings is also included in furniture and fittings. So any office equipment, everything will be included in furniture and fittings. That is 10%. Next is plant and machinery. Plant and machinery is also for cars. So if it's a motor car whose business is not hiring, it is 50%. If it is in the business of hiring, it is 30%. So that's what it is. If it is not in the business of hire and it has been purchased between 23rd August 19 and 31st March 2020, they are encouraging you to buy more cars. So they are letting you claim double the 30%. Instead of 15%, you are claiming 30%. So that is 2x. 2 times 15, instead of 15, you are claiming 30. Whereas if you are in the business of hire, if you have purchased in that period, August 19 to 31st March 20, you are eligible for 1.5x. That is 30%. For 30%, you claim 45%. So it's like what? 15, 30, 45, right? So multiple of 15. So 15 is for not hire. 30 is for between that period for not hire. And for a hiring business also, it is 30%. For a hiring business, within that period, it is 45%. So 15, 30, and 45 is the numbers that you can remember. So that's what it is about cars. Apart from cars, aeroplanes and all, it is 40%. For computers, including software. So for computers, including software. So basically the software which are mandatory to run your computer, what comes along with the computer, what are inbuilt into the computer, you get 40%. And for any other plant and machinery, it is 15%. For any other plant and machinery, it is 15%. So these are all important for tangible assets. Okay, all this what we are calling as tangible specified assets. About intangible, when it comes to intangible, it is flat 25%, or 1/4. So 25% is eligible for all the business, all the intangible assets such as no patent, copyright, trademark, license, or anything in the business or commercial rights other than goodwill. So for this, it is 25%. So all this will fall under intangible. So these are all the rates. These are all the rates for assets depreciation. So now we understand the method, the rate, and also the concept of additional depreciation. So we also understood when should depreciation provided. So we saw three conditions, that is specified asset, used by the assessee, owned by the assessee. That's what we saw. We saw the method, rate, and additional depreciation. Now we will solve a small problem for this, and then we'll have some multiple choice questions. Probably another 10-15 minutes extra will be there. Before that, I'll try to answer some of the questions on these questions. Yeah, depreciation is a reduction in asset wear and tear good. So many of you have answered about depreciation. Parthasarthi, Nikita, Harini, Dhyanesh, Shivlani, all those. Bhargavi, Arshil. So many of you have answered about Mohammed, Surender, Geet, Priyanka. All of you have answered about depreciation. Very good. So that's what depreciation is about. Kavita, passive use means that I am not using it. Like in the business of leasing, I own the asset, I have rented it out to others. So my business itself is leasing. So I am a passive user. I am not actually using the asset, but it is my asset. It is for my business only, just that someone else is using for me. So that's what passive use is. Yeah, Mohammed, land is not a depreciable asset. So it has only appreciation. Abdul, Dhyanesh, yeah. 43 is definition section. Very good, Dhyanesh. What is tea bushes, Kavisha, Abdul? Tea bushes is basically tea plants. Okay, tea plants. So plants, tea plants are not considered as an asset. For some of them, the tea plant is an asset. Out of that, they get this tea and other things. So the tea plants are not your assets. If a person is engaged in constructing and selling of land and building, will that building be depreciated? No. Harini, because it will form part of depreciation. Dhyanesh, straight line method and diminishing. Yeah, that's good. So what are the things? Why more power benefits is given to power generation? See, because power generation units have a different set of assets, and they primarily thrive on those assets. So there is an extra benefit. Let's not go much deep into it. So power generation unit have a very long life of assets, and they keep establishing in different situations repeatedly. So they need a different life utility. So because of that, power generation has a different life cycle. So that's why it's given. No additional depreciation before 1st April 2000. I think that date is irrelevant, because whatever is relevant for you, it must have been purchased an asset between 1st April 2022 to 31st March 2023. So yes, it is right, Abdul, that before 1st April 2005, additional depreciation is not allowed. But what is relevant for examination is the asset must have been purchased between 1st April 2022 and 31st March 2023. Harini, it is only provided in the first year. 20% additional, apart from, if you're, let's say it's a car, you provide 15% plus 20%. So it's like you provide 35%. Is it provided for all assets? We saw it is only provided for plant and machinery. We also saw exceptions. What is the meaning of block? Similar assets are called as block of assets. So all building, residential building categorized as 5% is separately called as a block. All cars categorized under this 15% or 30% is a separate block. So group of common asset is generally called as a block, which will have a same depreciation rate and same category of asset. Any animal is not included, not just livestock, any animals. It could be a livestock like hen, goat, or whatever. It could also be any other animal. So animals itself is not considered generally. So we can leave the word livestock. We can treat it as any animals. Okay. So we'll go into this problem. So basically there is an opening balance of 30 lakhs. So we'll call it as normal additional total. Okay, we'll call it this way. Okay, so basically the first thing is the asset opening balance on 1st April 22 is 30 lakhs, correct? So opening, we'll also have a reference column. We'll call it as working reference. We'll call it as working reference. So opening column plus addition. So basically, when you calculate depreciation, it will be like you have 30 lakhs, right? 30 lakh is opening. So you provide full year depreciation. 20 lakh is purchased on 8th June 2022, which is more than 180 days. So this is also eligible for full depreciation. So which means on this 50 lakhs, you will claim full depreciation, right? So it is 50 lakhs into 15%. So that is what? 7.5 lakhs, right? Yeah. So all these are plant and machinery. So it is general plant and machinery. So it is 7,50,000. Now this 20 lakhs is purchased during the year. So they're eligible for additional 20%. So that means it is eligible for additional 4 lakhs. So we'll probably put it here. So which is nothing but 20 lakhs into 20%. I'll probably have it for better understanding. So we'll say opening, which is 30 into 15%. It is 4,50,000. Okay. There is no additional depreciation on that. So it is 4,50,000. For 8th June 2022, it is 20 lakhs into 15%, which is 3 lakhs. And 20 lakhs into 20%, that is additional depreciation, correct? That is how much? 4 lakhs. So this put together, let's assume it is 7 lakhs for this asset, correct? 7 lakhs for this asset. The next asset is 15th December, which means it's less than 180 days. So that's also plant and machinery. So basically, 15th December 2022, how much it is? 8 lakhs. So 8 lakhs into 15% into 1/2. Same way, 8 lakhs into 20% into 1/2. That is nothing but half depreciation. So 8 lakh, 15% is 1,20,000, right? 80 plus 40, 120. Half of 120 is 60,000. And here 8 lakh, 10%. So that is 80,000. So put together 1,40,000 for this asset. Then computer. Computer is purchased on 2nd January and it is for office premises. So which means if an asset is purchased for office premises, it is not eligible. It is not eligible to claim depreciation. So this 3 lakhs. This 3 lakh is only eligible for half year depreciation. How much? What is the rate for computer? It is 40%. So 40% into 1/2, correct? So it is no additional depreciation. So 3 lakh of 40% is 1,20,000. So half of it is 60,000. You will have to add a note saying that additional depreciation is not eligible for computer because computer is installed in office premises. So basically, income tax is about understanding a provision. It is about understanding a provision. So unless you clearly state it as notes, the purpose, your objective of answering your income tax question is conveying the valuer that you have understood the provision. So when you add the word that additional depreciation is not allowed because it is for office premises, which means the valuer will know you have understood the provision. You have understood the provision of not writing, and not just you have just come out with zero. You know why you have not applied additional depreciation. So moment you convey that the valuer will start knowing. The impression on the valuer will be that this person knows the subject. This person has understood the provision. So moment you give that confidence to the valuer will start throwing marks at you. So please understand, you must make sure that you convey the valuer that you know the provision. How do you do that? Through notes. So to write note saying that computer additional depreciation is not provided to computer because it is installed for office premises. So that's what you do. So please remember, it is very important to have notes. So what is the total depreciation? So the total depreciation will be, so this is 7.5 plus 1.2, that is 8,70,000. And here it is additional depreciation is 4,80,000. Correct? So totally it is 12 lakh and 13,50,000. So the total depreciation will be 13,50,000. So that's what it is about your total depreciation. So clear? So that's all about today's session. I'll try to see if there are some questions and answer it. Depreciation charge will be on WDV for general businesses, Shiplani. It is only for power business. It is on straight line method. So for everyone else, it is the WDV. Abhishek, additional depreciation is allowed in the year of purchase, new purchase. If you see, this is a new purchase. This is a new purchase. This is a new purchase. So for these three assets, additional depreciation can be provided if they are an eligible asset. So this was eligible, this was eligible, this was not eligible, right? So additional depreciation is eligible only for assets which are purchased during the year. That is, for your examination, it must be purchased between 1st April 2022 and 31st March 2023. So that's what it is about. So as there are no other questions, probably I will just wind up the session. So whatever we have seen today, I'll upload both the slides and the notes. I'll upload it today, so you can use it then. So we'll see in the next session, continue with from where we have left out. So thank you for the wonderful session. See you in the next session. Thank you.